Ever wish you had a kind of secret map for, navigating the crazy world of investing? Maybe a shortcut to being truly informed without getting buried in all that jargon. Okay, let's unpack this today. We're diving deep into a really insightful newsletter from the Macro Butler. It's got this provocative title, The Wise Invest, Where Royalty Flows. So that's our mission here. We want to pull out the most important nuggets from this material. We'll cover understanding economic cycles, all the way to discovering a pretty unique asset class, one that could really change how you think about building a resilient portfolio. Get ready for some aha moments, I think, because we're exploring strategies designed not just for growth, but for, real financial wisdom.
Yeah, and what's fascinating here is how the newsletter sort of guides us through the shifting sands of the global economy. It's a good reminder that different assets really shine in different seasons, And then it brings in this unique investment approach. For a lot of people, I think it might feel like finding a hidden gem. We're talking about royalty investments. The newsletter actually positions them as the sensible, well-behaved cousin at the family reunion of assets.
Exactly. I like that analogy. It promises or suggests the potential for equity-style returns, but without all the drama. Plus, a hedge against inflation and this nice streak of non-cyclical stability. Seems like a unique mix. Okay, but before we get to the royalty part, the newsletter kicks things off by reminding us about the business cycle, those 4 distinct seasons. It calls them a crucial backdrop for any investment strategy. Could you walk us through this?
Certainly. Yeah, the newsletter maps out the economic year pretty clearly. First, you've got spring. This usually follows a deflationary bust. You see rate cuts, maybe some fiscal rescue. It ignites disinflationary growth. Growth stocks tend to plume here. Then comes summer. Things heat up. Inflation climbs. And that's when cyclicals, commodities, emerging markets often take the spotlight. After that, you get autumn. Kind of the dreary season, stagflation. Growth slows, inflation persists. Almost everything wilts in this phase, except maybe gold and, cold hard cash. And finally, winter. The icy recession arrives. Inflation usually recedes then. And that's when long-term treasuries can have their fleeting moment as markets' unlikely heroes.
Okay, so understanding these seasons isn't just theory. It really dictates where our money should be, potentially. So given that framework, what does the newsletter say about where we are now? What's the current climate, according to them?
Right. Well, the newsletter points out that as of August 22nd, 2025, the U.S. is still technically in an inflationary boom. But, and this is important, it issues a strong warning. It says an inflationary bust will materialize much sooner than, quote, Wall Street pundits and their parrots are telling clients. It even points to an indicator, the S&P 500 to gold ratio. It's been below its 7-year moving average for 7 months now. That signals a shift is coming. So it raises this really important question for you. Are you prepared for stagflation? The emphasis, it suggests, needs to shift from the usual return on capital to maybe return of capital.
That's a powerful shift in perspective. Return of capital, not just on it. Prioritizing preservation.
So this brings us to one approach the newsletter specifically mentions for weathering all these seasons. Harry Brown's permanent portfolio. What exactly is that, and why highlight it now? Well, Brown's approach is fascinating. It's built precisely to handle any economic climate. Growth, inflation, deflation, recession, you name it. The goal is steady returns. It does this by spreading capital across assets that tend to perform well in those different conditions. The idea is to sidestep those really catastrophic losses. It really suits investors who value, let's say, low drama, capital preservation, modest growth, minimal tinkering, rather than the thrills and spills of constant rebalancing.
Okay, low drama sounds good. But how does it actually work? This idea of portfolio geometry sounds interesting. A bit abstract, Emmy?
Yeah, it does sound a bit academic, but think of it like a simple grid, a Cartesian coordinate system for your finances, if you like.
Okay.
Financial assets get divided into 2 camps. You've got contracts, things like bonds that promise future payments, and then properties like stocks, representing ownership claims. Both of these can span different time horizons, so long duration, like government bonds or equities, or short duration, like cash and gold. So you end up with these 4 quadrants: contracts versus properties on one axis, short versus long duration on the other. It's this balanced spread that helps it perform reasonably well across different conditions. That's the core idea.
Right, a balanced spread for different weathers. And how is it actually performed? I mean, does this conservative approach deliver, or is it just about not losing money?
Well, according to Gavical Research, which the newsletter cites, Brown's permanent portfolio delivered a pretty steady 3 to 4% annual real return across different currencies, too, and with such low volatility that, quote, double-digit drawdowns virtually extinct. For American investors specifically, it apparently cranked out about 6.5% a year in nominal terms over 35 years, which works out to around 3.9% adjusted for inflation, or what the newsletter cheekily calls the CP lie.
The CP lie. What's the CP referring to there, and why such a strong term?
The CP stands for Consumer Price Index, the official inflation measure. The newsletter uses that term CPI to sort of imply that the official numbers might not fully capture the real erosion of purchasing power for investors.
Ah, okay, suggesting real inflation might be higher than reported.
Exactly. So while the portfolio isn't flashy, the point is it won't give you a heart attack every other cycle, especially if true inflation is eating away more than the official stats show.
Got it. So the permanent portfolio is one path to stability. But the newsletter's title, The Wise Invest Where Royalty Flows, clearly points us somewhere else, towards this specific type of asset. What exactly are royalty companies? Why are they these oddballs that investors secretly love, as the piece puts it?
Yeah, royalty companies are definitely unique. Instead of lending money like a bank or taking equity like a VC, they provide cash up front to a company. And in exchange, they get a slice of its future revenues. The newsletter puts it simply. It's like a financial version of I'll take 5% of whatever you make forever, or at least for a long time. So the company gets funding without debt hanging over it or diluting existing shareholders. And the investors. They get returns tied directly to how well the company does, top-line performance. These deals can run for decades, sometimes even perpetually, until the end of time, as they say.
So it's almost like a modern-day King's Cut, taking percentage.
Precisely. Yeah, the newsletter actually traces it back. Kings demanding a cut of whatever was dug, grow, or write. Then it evolved, through medieval miners, Renaissance authors, and now it's got this corporate makeover. So today, royalty companies let investors collect a steady stream from, well, all sorts of things. Gold mines, drug patents, basically, as the newsletter puts it, making money off other people's work while wearing a suit instead of a crown.
That sounds like capitalism with a very clever twist. So how does this model actually work for both sides, the entrepreneur needing cash and the investor looking for returns?
Well, the newsletter calls royalty financing venturing capital without the drama and debt without the handcuffs. It's a nice line. A company gets an upfront sum and advance. In return, the investors skim a percentage off the top future revenues. Entrepreneurs often love it. They keep your equity, avoid a ton of securities law paperwork, and importantly, they don't owe fixed payments like they would with debt. If sales dip, the royalty payment dips too. Investors like it because the returns rise with sales. If it's slow and steady, maybe they net 11%. But if the company really booms, returns can shoot past 20%. It's capitalism's version of have your cake and give me a slice every month.
Okay, here's where it gets really interesting for me. The newsletter says a royalty investment is like owning a toll booth on someone else's asset. That's a powerful image. What are the core benefits there?
The beauty is exactly that. Investors earn cash based on sales, the top line, not the bottom line. So they avoid the headaches of actually running the business. No worrying about OPEX operating expenses or CAPEX capital expenditures or profit margins. And because royalties track revenue, not profits, they often behave differently from traditional stocks or bonds. This can provide steady, predictable cash flows, often with some inflation protection built in, and crucially, low correlation to other markets.
So less tied to the day-to-day market swings.
Often, yeah. In short, it's a way to, as they say, sip steadily from an asset's income stream with upside optional but never mandatory.
Now, when I hear royalty, my mind immediately jumps to, gold mines, natural resources. But the newsletter suggests these companies have gone on a world tour. What other sectors are playing this game now?
Oh, the expansion is quite remarkable. Yes, they started with gold and silver, but the model's been adopted way beyond that. In energy, you have firms like Texas Pacific Land, Prairie Sky. They basically sit back while oil and gas producers do the dirty work and just send them checks based on production. Then there's music. Companies like Hypnosis, Roundhill, they buy up music catalogs.
Right, song rights.
Exactly. And they get paid every time someone streams a hit on Spotify or uses it in a movie or sings karaoke. The newsletter even mentions a specific catalog with Jay-Z's Empire State of Mind. It was bringing in about $30,000 a year, and cash flow is growing nicely thanks to streaming. Music royalties offer recurring income, attractive yields sometimes, and again, often low correlation to the wider market. Then you have pharma. Royalty pharma is a big one. They front cash to drug makers for development, then collect a slice of revenues if a drug becomes a blockbuster. And even tech and consumer brands are in on it, turning patents, trademarks into regular rent checks, so to speak.
So it's really moved far beyond just digging stuff out of the ground. How do these royalty deals differ from, say, the more traditional mining streaming deals, especially in commodities.
That's a good distinction the newsletter makes. So streaming deals are usually for specific commodities from a specific project. The investor pays upfront and then gets the physical product like gold or silver delivered later, but at a preset discounted price. Royalty deals, though, are typically commodity agnostic. They pay a percentage of the total project revenue, usually in cash, regardless of what specific commodity is being sold or its price at that moment. And these mining royalties and streams have really grown, from maybe $2 billion in deals in 2010 to over $15 billion by 2019. Especially as traditional bank lending got tighter for miners, this whole model lets the royalty companies stay incredibly lean. They avoid the huge operational risks, the environmental stuff, the labor issues.
But still benefit if prices go up.
Exactly. They get exposure to rising commodity prices without owning the mine itself.
This sounds incredibly efficient. The newsletter makes some pretty bold claims, calling royalty companies straight-A students of capital discipline compared to the actual operators.
Yep.
Can you share some of those comparisons? They sounded quite striking.
They really are. It's a crucial insight. Royalty companies consistently punch above their weight, as they put it. They capture the economics without the operational bloat. So the example given is Wheaton Precious Metals. They employ only about 33 people. 33. But they generated over $1.2 billion in revenue in 2024.
Wow. With 33 people.
Right. Now compare that to, say, Newmont, a major traditional miner. They have 22,200 employees for their $18.6 billion in 2024 revenue. It just dramatically shows how efficient that royalty model can be at turning capital into cash flow. And the newsletter also highlights their discipline with debt. Newmont still carries a 20% debt-to-equity ratio, which isn't terrible, but Franco-Nevada, a top royalty firm. The newsletter says they don't even acknowledge debt exists, like they clear their Amex balance before the statement even hits, that kind of fiscal prudence.
And does all this efficiency and discipline translate into better returns for shareholders? Are they sharing the love?
Absolutely. Dividends, the newsletter says, are like a company's love letters to investors. A bit poetic, but
I like that.
yeah. And over the past 5 years, royalty giants like Franco-Nevada and Wheaton have shown impressive dividend growth. We're talking 8% to 11% annually. Now, compare that to the S&P 500's dividend growth, maybe 4.6%, or even the Philadelphia Gold and Silver Index at 6.5%. The message is pretty clear. Royalties know how to treat their shareholders.
Okay, it sounds very appealing, very sensible. But, no investment is entirely risk-free, even this sensible cousin. What are some of the potential downsides or pitfalls the newsletter warns about with royalties?
Right, it's important to look at the risk. And yes, royalties have them. The newsletter outlines a few key areas. First, you've got sector-specific factors. Think regulatory changes. What if streaming models change dramatically in music? Or a new drug makes an old patent obsolete in pharma? Consumer tastes shift. Then there are counterparty legal and diversification risks. Problems can pop up. Maybe liens on the asset, divorces messing up ownership, or just plain shady paperwork from the owner of the asset. Counterparty risk is basically, will the person who owes you the royalty actually pay up? Can they? And finally, asset level issues. Maybe operational problems at the mine or the drug has side effects, leadership changes at the company, unexpected stuff happens. For music royalties specifically, it warns that overpaying for a young catalog is like buying a one-hit wonder at full price. Good line.
Yeah, that makes sense.
And it also notes Spotify isn't giving you more per stream just because coffee prices jumped. Meaning some royalties, especially fixed per stream ones, don't automatically adjust for inflation.
Okay, so there are definitely things to watch out for. How can investors try to mitigate these risks? Make sure it's a steady stream, not a surprise waterfall.
Well, the usual suspects apply. Careful due diligence is critical. You really need to understand the underlying asset and the contract. Favorable contract terms help. Things like step-up, step-down structures, make whole payments, clauses that offer protection. And diversification, of course. Spreading exposure across different sectors, different assets, different counterparties. Hedging strategies can also play a role. And understanding where an asset is in its life cycle matters too. Is it a brand new mine or a proven producer? But the newsletter also points to significant opportunities, especially in oil and gas royalties. It calls it a $600 billion market, but only about $42 billion of that is currently public.
Wow, so most of it is still private.
Exactly. It leaves $500 billion in private hands waiting for consolidation. And there are trillions in dry powder investment capital apparently sloshing around looking for deals. It offers a way to get energy exposure without getting your hands dirty with drilling rigs.
And are there any external factors, maybe political or regulatory, that are favoring these investments right now, particularly mineral royalties?
Well, according to the newsletter, yes. It points to the Republican 2025 budget, describing it as offering a kind of VIP pass for mineral royalty investors. This apparently includes more room for MLPs, master limited partnerships, and REITs, real estate investment trusts, to hold royalties. Also mentions a permanently glued 20% partnership deduction and private equity getting a free pass on some carried interest rules from 2018. Plus, for now, no U.S. carbon tax. Although it does mention the EU's Carbon Border Adjustment Mechanism, the CBAM, could cast a shadow later on U.S. mineral royalties tied to fossil fuels.
Okay, this is genuinely fascinating, a potentially rewarding area. So for our listeners who are intrigued, how do you actually invest in these royalty streams? Is it easy to just jump in? Can the average person do this?
That's a really important question. Accessibility. And the newsletter is pretty clear. Jumping into a royalty deal isn't for the faint of heart. It calls it basically private equity with a twist. It demands, well, a lot. Crystal ball revenue projections, Sherlock-level due diligence, and enough legal muscle to make a courtroom blush.
Okay, so not exactly a casual weekend project.
Not really. You need to value these often unpredictable income streams, monitor payments meticulously, figure out exit strategies, parse really complex contracts. For most people, the newsletter suggests hiring a specialist fund manager is the smart move. It really takes a small army of accountants, auditors, and industry pros to do it right.
So there's no simple ETF like an exchange-traded fund for the everyday U.S. investor that just bundles up a bunch of these royalty companies.
Unfortunately, no, not listed in the U.S., as the newsletter points out. There isn't one that specifically targets a broad basket of royalty companies across different sectors. So you can't just click Buy ETF and get instant diversified exposure that way. You really have to roll up your sleeves, dig into asset quality, check balance sheet muscle, and make sure those income streams aren't just smoke and mirrors. It requires individual company research.
But you mentioned an option for people who can access international markets.
Yes, that's right. For investors whose brokerage accounts allow trading on the Australian Stock Exchange, the ASX, there's the BetaShares Global Royalties ETF. The ticker is ROLAU. It offers exposure to a diversified portfolio of global companies that get revenue from royalties. It covers gold, oil and gas, movies, entertainment, semiconductors, biotech, and nearly 70% of its holdings are actually in the US and Canada, despite being listed in Australia. The newsletter notes it delivered superior returns in US dollars compared to the S&P 500 and MSCI World from late 2023 to mid-2025, with lower volatility too. And it pays a monthly dividend yielding about 5.9% annualized recently. And specifically for music IP, there are sort of three routes. Buy into label publishers, join royalty funds like Hypnosis or Mills Music Trust, those are often for the very wealthy. Or last snag direct stakes in songs or catalogs via platforms like Royalty Exchange. There, even a smaller investment, say $5, can get you that mailbox money every time a song gets played.
Okay, let's bring it all back to the bigger picture. Those larger economic shifts the newsletter started with. What's the ultimate takeaway for investors as we potentially head into this inflationary bust they predict? What's the core guidance?
The newsletter paints a stark picture, really. It says the Goldilocks era is dead. That just right economy. The new survival playbook, it argues, is the age of gold in lots. GOLDINLOTS. It's pretty unequivocal. It states that physical gold and silver, free from counterparties, free from surveillance, stand as the ultimate anti-fragile shields. Anti-fragile meaning they don't just withstand chaos, they can actually benefit from it.
Strong words.
Very strong. They're presented as the eternal hedge against collective stupidity and government hegemony. And the argument is, with trust in public institutions declining, investors will increasingly move into these non-confiscable assets, physical gold, physical silver. It even states, very provocatively, in gold we trust because gold is for war.
In gold we trust because gold is for war. That's incredibly strong language. What's the argument behind that specific assertion? And what about cash and bonds in this kind of world?
Well, the underlying argument seems to be that in extreme scenarios, geopolitical turmoil, major systemic crises, war gold becomes the ultimate, universally accepted store of value, completely outside any single government's control or financial system. As for cash and bonds, the advice on cash is to be precise. Favor short-dated U.S. dollar investment-grade bonds and T-bills. Keep duration very short, not longer than 12 months. But it starkly labels long-dated U.S. treasuries and bonds as an uninvestable, returnless asset class. Says they've lost their rationale for being part of a diversified portfolio. Basically arguing that traditional fixed income has actually become the risky part of the portfolio now, not the safe part.
Wow. Fixed income becoming the risky part. That flips conventional wisdom on its head. And for equities, given this rather gloomy outlook, what's the play there?
For equities, the focus shifts. It should be on lean, low-debt, high-cash flow champions. Businesses that are positioned to thrive amid trends like reshoring, potential trade wars, maybe surging defense budgets, quality companies, basically. But the newsletter warns everyone to be prepared for much higher volatility overall, and likely dull inflation-adjusted returns from broad equity markets for the foreseeable future. The overall playbook boils down to defense. Don't get confiscated, don't get frozen, and don't get poor trying to get rich. Prioritize protecting what you have.
Wow. Okay, that was a truly packed and insightful deep dive into the wise invest where royalty flows. We've covered a lot those economic seasons, conservative ideas like the permanent portfolio, and then this really fascinating expanding world of royalty investments, from gold mines all the way to pop songs.
Yeah, and if you tie it all together, connect it back to that big picture. The message is pretty clear. The global economy, according to this view, is heading for an inevitable inflationary bust. And the newsletter's core theme is really a reminder that tangible assets endure while paper promises burn. Hard assets matter. It really challenges us to think beyond the usual investment paths, to realize that, in their view, the future will not be won by those who innovate fastest, but by those who hold what cannot be printed, censored, or erased.
So what does this all mean for you, our listener? I guess it's about being prepared, being strategic, and maybe understanding that true power in investing, according to this perspective, comes from restraint, from perspective, with real liberty and liquidity perhaps living more in personal vaults than just in banks.
And that really raises a critical question for you to think about. In this world of, let's face it, increasing uncertainty, maybe declining trust in some institutions, how much of your wealth truly resides in assets that are genuinely non-confiscable, assets that have no counterparty risk?
That is a powerful thought to ponder as you navigate your own financial journey. And remember, as the Macro Butler newsletter wisely reminds us near the end, humility is royalty without a crown. We really hope this deep dive has given you some powerful new perspectives to consider.
Until next time, stay curious, stay informed, and keep digging for those valuable nuggets of